Good morning friends, myself Dinesh from Fundamental Research. I'll be talking about Q2FY14 Sensex earnings preview. We expect in Q2 the revenue growth to revive, largely contributed by the rupee depreciation. For Sensex companies on aggregate basis, we expect revenues to grow by 10.4% YOY. And as I said, it will be largely contributed by the rupee depreciation. The export-led sectors such as IT and pharma will gain significantly, as we expect the revenues growth in these sectors to be around 25% plus on a YOY basis. Apart from IT pharma, the companies like RIL and Tata Motors will also benefit significantly from the rupee depreciation. However, the domestic dependent companies sectors such as power, telecom and capital goods would see anemic growth in the revenues. As far as operating performance is concerned, we expect the EBITDA margins to remain largely stable on a sequential basis. We will see the uptick in margins for the sectors such as IT and pharma, which will be offset by margin erosion in sectors like capital goods, utilities and banking sector. In case of banking sector, we expect higher interest expenses and treasury losses to weaken the profitability of banks, which will ultimately impact the overall earnings outlook. On aggregate basis, we expect Sensex earnings to grow by about 4% YOY. Again, would be contributed by a strong growth in IT pharma sectors, but would be impacted by the slower growth in sectors such as banking, capital goods, etc. As far as the outlook for the earnings is concerned, we believe that apart from the moderate growth in earnings, the quality of earnings is concerning, since it is concentrated largely in few sectors such as IT, pharma and metals. The earnings spread continues to remain poor, as 12 out of 14 or 12 out of 30 companies in the index are expected to show a decline in their net earnings on a YOY basis. Given multiple pressure points such as monetary tightening by RBI, slower economic growth and exchange rate volatility, the downgrade in consensus earning estimates, especially for the cyclical sectors such as banking and capital goods, is not completely ruled out. Going ahead, RBI's stance on the interest rates and the extent of revival in the domestic economy will be keenly watched from the earnings perspective. Thank you.